Welcome back to On the Money and Redefining Your Retirement with Ryan Wheless. Structured notes. Love coming right out of the gate with this. And I get it. A little bit of downside protection. Could go, all right, you know what, it made me think of the Titanic, okay? If the water got over the baffles, if it goes a little too far, it could still sink, right? If you go below your threshold of a 30% loss or 40% loss, you might take some loss. But the concept is to help you.
Spike, remember, the note has to mature with your indices down that far. So let's say you have a 1-year note. We buy the S&P at 1,000. So the index is at 1,000, and that's our underlying index. We call it constituent, by the way. Okay, so we're at 1,000, and 6 months in, the S&P drops 40%. Okay, you haven't lost a dime. The only thing you would not get that month is your coupon. So if that note was paying 10% annualized yield, you wouldn't get the 10% coupon that month because you're below your barrier. All right, but if the market snaps back and gets back to even or above that, by the 1-year period where your note matures, you don't lose a dime. Mm-hmm. So the interim period of 1 year, 2 years, 3 years, 5 years, the market can do whatever it wants to. Mm-hmm. If it goes below your coupon barrier, you may not get your coupon that month, but the market pretty much do what it wants to. And as long as the market on the date your note matures is not down 20, 30, or 40%, whatever your barrier number is, you wouldn't lose any money in that case.
Now, with our interest rate conversation, and I was going to include it in today's research on the program, but I was even getting lost in the boredom of it. Oh, and by the way, actually, I was reading one of the articles of, you know the name, Rick Edelman, and he was writing about how easy or hard is it for the president to influence the interest rates or even to remove a Fed chair. And then he got all the way deep into the Fed governors and all of the other people who actually have to vote. It's not just up to Jerome Powell to change interest rates. It actually has to go before the entire, FOMC Board of Governors, and 7 of them, I think, all have to agree on whether it's going to go up or down or stay the same. Anywho, will interest rates affect the performance of something like a structured note? Do you have kind of a time frame duration that you're a fan of or not a fan of on these structured notes? 1 or 2 years right now because of the interest rate conversation?
The longer the interest rate, and this gets a little complicated to talk about on the radio because we're buying a zero coupon bond, okay? When interest rates rise, the price of a zero coupon bond falls. Okay. When interest rates fall, the price of a zero coupon bond rises. Okay. So inverse relationship to rates. But the coupon bonds are priced on their current values, right? The other aspect of it is is volatility in the markets. So those things can play a role in the growth rate on growth notes. They can play a role on the interest rate that you get on the monthly coupons, or the rates of return you get for monthly interest. So your 10% note, 11% note, 12% note, whatever it is. But once you buy these, whatever the rate is at that time is what you get. Again, you buy one this, I'm going to buy, I've got, and by the way, you can buy these things for as little as $1,000 increments, by the way. Okay. And so you buy one today and you hold it for a year. And if it paid 10% and the market was flat or slightly positive, you get all your money back. You get all your coupon payments. And now you're going, well, that worked out really well. Now we got to find another one. Okay. But we get a constant flux of inventory in these notes each week in our office and through our provider. And we always have opportunities for better. Not just for better, but we have, if notes mature or get called, we've got plenty more inventory out there. And this is taken in spite what we're getting into here is alternative assets. Okay. Yes. Alternative assets are things like private credit, private equity, private real estate funds, and structured notes. All right. And what's beginning to happen, and I think it's a great thing, by the way, is these types of investment opportunities are typically reserved for accredited investors. It's not the case with structured notes, by the way. I like that. But what's happening more and more is investment companies are trying to get these structured notes, these alternative investments, private equity, private credit, private real estate funds. They're trying to get them to lower net worth folks because they can be a great alternative to stock market. The problem with the stock market is everything is public. The thing about that is everything is public. What happens is if I hear Trump come out and say, hey, we're going to go bomb Russia, dude, that's going to scare me in a big way, right? And I'm quite certain we're going to see some volatility in the stock markets, okay? And I might be an investor in the stock market who goes, well, I'm going to pull my 401k out of the market. And other people might go, I'm getting out of the markets altogether. Well, if people are ripping their money out of the markets that fast, what happens to the market? It goes down because sellers or overwhelming buyers. And when that happens, the market falls dramatically. Go look at 08, 09. Go look at COVID crash. Okay. Go look at the tariff tantrum this year. That's what happens. Well, if you get into the private stuff, it's not publicly traded. So the volatility levels aren't there. Okay.
I was waiting for these dots to get connected. I'm like, I know he's going to make sense. But...
Yeah, but think
okay,
about
now
that.
I get it.
And that's why these investments are often more time oriented. Okay, time commitments on the funds. They're less liquid. You're not getting your money out of a structured note in the interim. You probably could sell it in a secondary market, but you would lose money. That wouldn't make sense. Right?
That was something I was reading saying. It said generally less liquid, but I mean, it all depends on other structure, but you probably could get your money out.
That's the problem with any alternative investment is liquidity, bud. I mean, anytime you're talking about alternative investments, there's going to be liquidity issues, but that liquidity issue, the lack of liquidity is there to protect the managers of these funds because they don't have to worry about Trump coming out today and saying he's going to bomb Russia, and then everybody starts pulling out the money out of the stock market and freaking out, and the market plummets because sellers are overwhelming buyers.
So in a way, this kind of private tool that you're talking about, I'm not saying completely across the board. We both are understanding compliance and we have to be careful what we say over a radio show, but almost a little bit more safe because they're not publicly traded in that sort of way.
They're higher risk, Spike, in a lot of ways, but they're lower volatility.
Volatility,
which I know it doesn't make sense, right? But that's just the way it is because the stuff that's happening behind the scenes is not traded over a stock exchange with full public view and insight. And this stuff has been going on for years. I mean, the great motivational speaker, Tony Robbins, has written 2 books, has come out, vehemently and said, guys, if you put money in the S&P 500 for the last 40 years, it grew by 10% or whatever it was, right? Or an average return a year. And he's like, if you put money in private equity and private credit, it grew by like 4 or 5 times that. And that's Tony Robbins saying this stuff, right? So, and the reason why he's looking for this, by the way, is he's done very well. I think Tony's net worth is pushing $1 billion. People need to know about this stuff, right? There's alternatives to being just in the stock market. And I think it's one of these things where there's no perfect tool out there because some of these funds, like private equity funds, require a lockup of capital of 10 years, okay? Well, if you got $1 million, you might not be able to lock up capital for 10 years, right? Because you need access to your money. Then there's funds that are called perpetuity funds to where they have liquidity every single quarter. Now, the perpetuity funds won't perform as well as the funds with a lockup because guess what? They have to let people out of the funds and they have to de-risk the portfolio some to allow for liquidity. And what people don't know, Spike, that's mind-boggling to me is the ability to liquidate your portfolio out of the stock market like that is one of the largest reasons we have the volatility of the stock market that we do.
A lot of people have invested, when you say the liquidity of your 401ks, there's still a larger majority of 401ks that are invested in mutual funds, which are a T+3, correct? Right? So like, there's a difference between an exchange-traded fund and a mutual fund is your immediate tradability.
Settlement date, though. Settlement date has nothing to do with it, bud. That's settlement. That's what happens after the securities are sold.
Okay.
Right? That's settlement of funds. Once I execute a trade on an ETF, it's done. Once I execute a trade on a mutual fund, it's done at the close of business that day, 3 p.m. when the market closes here in Texas. But it's done that day. So it's interesting, but that ability to sell and liquidate and get out that quickly, that is what creates the volatility in the stock market.
I'm going to keep this white-hot conversation going when we come back from the bottom of the hour break here. Folks, call right now. Let's do your complete, your risk review, your asset review. What are you using? What are the tools? What are you possibly missing? I think that's a bigger part of the picture. It's not what you think you know. It's what you don't know. It's what you are unaware of what could be available out there for you. Yeah, you've had all of your retirement accounts to help you get to this point. What else is out there for you? Isn't it worth just a second opinion review? Call 844-944-7555 right now. People are standing by. They'll schedule an appointment for you. Like Ryan said, do a 30-minute conversation with you. You get over the Zoom if you want to. Or you can come on into any one of the 5, 6, 7 offices all around here in Texas. And if you're anywhere around the nation watching this YouTube video, feel free to call as well. 844-944-7555 or text us at 21000, the word plan. More with Ryan right after this.